Welcome to This Week in Money. I'm Jim Goddard. Today, CIBC Wood Gundy's Ross Clark will run down the latest from the major equity markets. Author of the book, The Money Bubble, John Rubino believes gold bugs will likely be the big winners because of the uncertainty created by President Trump's controversial and often contradictory policies. The Corbett reports. James Corbett looks at Asian reaction to what's happening in Washington, D.C., and Trump's past dealings in Russia. Plus, at the end of the show, we'll have a company showcase update with American Manganese President and CEO Larry Reaugh. We'll talk to Ross Clark right after this.
I'm Larry Reaugh, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Reaugh, at 778-574-4444.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark. He's an investment advisor at CIBC Wood Gundy in Vancouver. Welcome back to This Week in Money, Ross.
Always a pleasure, Jim.
Big headlines earlier in the week. The Dow hits 20,000. Did that number really mean anything?
Well, it's just an index, and it's an index that is always undergoing change. And when we take a look at the makeup of what's in there now versus what it was when it went through 10,000 or 1,000, it really is not that representative as far as the total market is concerned. And you find that even with indices such as the S&P, which is a capitalization-weighted index, there aren't many people that I know who have a capitalization-weighted account, and clearly it's a good psychological number to be for everyone to talk about. The media will be all over it. But in reality, it's just another level on the way up. We spent the better part of, I think, of maybe 5 weeks in December, the early part of January, consolidating below it. Did that also with the other indices, including Canada, which have broken out. But bottom line, the trend has been up. We've had a pause. We've made a new high, and it's pretty darn important. This time of year, especially when we go back, and we love to tear these historical records apart and see where the specific criteria fit in, what type of anomalies there are. And in the first year of a first-term president, which is what they've got in the U.S. right now, the early part of the year really tells the tale. So, having made a new high, having in the second half of January here, there should be follow-through into February, ideally till about mid-month, and then we would be a correction in the vicinity of maybe 3 to 7%. So that would be the criteria that we will be looking for. If it starts to deviate from that, it'll be a big red flag. But for now, that's the scenario that we want to have. The move was fairly significant in terms of the 3 days that the market did run up and go through the 20,000 middle of the week. It would normally be much more of a grind now as we move higher. Nothing of that pace. Much slower movement into the middle of the month. And at that point, we should also have a better idea of what this administration is able to put through. The first week, lots of things as far as discussion on trade, NAFTA, Mexico. You're going to have your first visit from a foreign leader coming up this week with Britain, and who knows, who will be next. But this is going to be a very important calendar quarter.
Is it good for Canada to not really being at the top of the Trump agenda?
Well, we're pretty high here on that agenda. We've gone from just general discussions about NAFTA and mostly about Mexico to now talking about actual import taxes into the states. That we'll see how that evolves, but we're best off to be, as we are right now, the quiet ones sitting back and let the negotiations move along probably slowly and quietly in the background rather than on Twitter feeds.
35 states say they are very dependent on active and free trade with Canada. Will that put pressure on Trump?
Oh, definitely. I mean, that is happening behind the scenes. There's no question that his advisors are being presented with this type of information from each of the states and many of the cities. The number of times that products move back and forth, some of these items, the manufacture of the individual parts and then the eventual assembly of them, they're talking maybe 6 times that things are crossing the border. And to be able to keep track of this, wow, it's going to be just a headache and a nightmare if they try and delve into it too deeply.
A bit of gold in the portfolio, a good idea in kind of unsettled times?
It tends to be, and we've been looking for an 8-year cycle low to kick in here in gold in the fourth quarter of last year through the early part of this year. It still hasn't proven itself. We had a nice low in December. We've had a good rally off the bottom, but it really needs we need to see it get up through the 1235 to 1240 range to prove that it's pretty much turned the corner. And we've been looking at the silver market pretty closely because it's walked down as badly, if not worse, than the gold market in the last few years. Did exceptionally well in the first half of 2016, and if we take a look at the miners, outpaced the bullion by about 150% of the moves, and then this year, coming off that December bottom, silver stocks are up about 20% better than the silver has bounced up. We have some good technical readings on this. Silver's pretty much boxed in. Supports around the 1630, resistance up around 1730. Closed off the week at 1710.
Ross, thanks a lot for chatting with us.
Always nice to be with you, Jim.
My guest has been Ross Clark, investment advisor at CIBC Wood Gundy in Vancouver. Coming up, John Rubino, next on This Week in Money.
Always consult your investment professional before making any investment decision.
GEM International is a new diamond explorer in the richest diamond-producing country in Africa, located next to the 4th largest producing diamond mine in the world. International Spotlight is on an 1109-carat diamond, recently discovered in Africa by a fellow Canadian junior, with a proven operator and finance team. GEM International trades on the TSX Venture Exchange, symbol GI. Visit us at gemdiamondmining.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. I'm Jim Goddard. My guest is John Rubino, author of several books on the economy, including The Money Bubble, his website, dollarcollapse.com. Welcome to the show, John.
Hey, Jim.
I've noticed a great similarity between Justin Trudeau and Donald Trump that maybe others haven't noticed. And that is within minutes of them being elected and put into office officially, they have followed up on their promises immediately, several of them.
Yeah, Trump has definitely hit the ground running. He's signing executive orders and at least indicating that he intends to do some stuff. He's bringing it up, which is another kind of campaign promise, but now that he's president, it carries a lot more weight. So yeah, we're going to renegotiate trade deals. So, it'll be interesting to see how the U.S. and Canada end up reworking NAFTA if he ends up doing what he says he's going to do. And then, of course, us in Mexico, if he builds that wall, which he intends to do apparently, and, lots of other things. He just apparently put a media blackout on the EPA, the Environmental Protection Agency, and several other government agencies, meaning that these guys can't have Facebook pages or anything in which they talk about work. So I don't know what to make of all of this, because some of it seems really authoritarian, and some of it seems like it's not exactly libertarian, but at least it skews in the direction of personal freedom. And that's pretty consistent with Donald Trump, the candidate, because he didn't really have an ideological identity. He was all over the place with his ideas and his promises and his likes and dislikes and his enemies and his friends. So it shouldn't be a surprise that as a president, he's still who he was all along. He's twittering at night and doing a lot of things. He's taking a lot of actions, although they don't necessarily have an ideological thrust. It's not like under Ronald Reagan, where you pretty much knew exactly where he stood on everything back in the day. And with Trump, it's kind of, each case is its own situation, and he looks at it with fresh eyes. So it's going to be hard to, it is hard right now to really map out where we go from here, but I think you can say with a high degree of certainty that there's going to be a lot of action and a lot of drama, which, if you own media stocks right now, you should probably be pretty happy, because TV ratings ought to be very high under Donald Trump, at least TV news ratings, because there's always going to be a new story every day.
Even though he hates the TV networks.
Yeah, isn't that funny? He's by being an enemy of the media, he attracts attention, which is great for the media. So yeah, they're probably deep into very mixed feelings about Donald Trump. They disagree with him politically and don't like him as a person, but they love the effect that he has on their bottom line. So I think, follow the money. They'll get used to him. If he stays as he is now, he's going to make these guys very rich. So they're going to be happy in the end.
Well, just taking a look at the numbers at the time of our interview, the Dow Industrials up 9% since the U.S. election. The Toronto Stock Exchange Financials up 11.5% since the U.S. election. It looks like business people and financial people are very happy with them. Also, J.P. Morgan and Goldman Sachs, their shares doing very well, and the Dow topped 20,000 for the first time. So in the business community, I think Donald Trump is number one.
Yeah, well, part of this is just we like new stuff. If you go to the grocery store and you look at the boxes on the shelf, you see all kinds of new and improved stickers on there, because the human nervous system loses interest in something that repeats, but is fascinated by something that's new in the environment, because it might be a threat or it might be an opportunity. And a big part of what's happening in the financial markets, I think, can be attributed to that. Oh, so there's something new happening. Let's buy some stock. I tend to think that our mistakes have already been made, and there's nothing Donald Trump or any other president can do to fix debt that is now 350 to 400% of GDP, for instance. That's an unfixable problem, or at least unfixable without immense amounts of pain. And eventually that's going to sink in. People are going to figure out that we can't function as a society in the U.S. without taking on several $1 trillion of new debt every year and not paying off our old debt. And at some point, which, I would have guessed it was 2005 when the debt becomes unmanageable and the system collapses. But at some point in the future, probably the not too distant future, the debt that we're taking on, added to the debt that we've already taken on, just becomes unmanageable, and the system is going to blow up on us. And at that point, it won't matter whether we've renegotiated NAFTA or whether there's a wall separating us from Mexico or whether we have 3 extra auto plants here than we would have otherwise. That stuff is going to be lost in the statistical noise. They're going to be rounding errors compared to this big, overwhelming problem, which is that our finances are blowing up on us. So that's still out there in the future. And, Donald Trump, love him or hate him, is entertaining. So we'll be entertained while this is going on. But we will not be happy about the world we live in 5 years from now. I can almost guarantee that. And probably the only people who are even marginally happy are the gold bugs. They're the ones who own the assets that are going to go up in the big crisis that's coming. So they will be, at least in in some way richer than they would have been otherwise. But most other people, people with stock and bond portfolios and pensions and government jobs and many private sector jobs, they're not going to be happy because their life is going to get much, much harder. And that's just the way it works when you have a credit crisis. Almost everybody suffers.
Trump, I think, has frozen government hiring. Or plans to?
Yes and no. He did freeze government hiring, and he ordered a lot of the departments to make cuts in their spending. But instead of saving that money or using it to pay off debt or giving it back to people via big tax cuts, although he does have some tax cuts in his set of policies he's requesting, he's mostly going to use that money to build up the military and to build out our infrastructure. So basically, the money is going to be spent, and we're going to have to borrow a lot to cover our costs. We will just be doing it on somewhat different things. Hillary Clinton, if she was president, would have spent the money on expanded food stamps and spreading out health care to everybody else and beefing up Social Security, stuff like that. Trump is going to spend it on the military and a big infrastructure build-out. Now, the Democrats would have also built up infrastructure if they could have, so that's one thing that is going to pass, because the Democrats like it too. So we will see a big infrastructure program paid for with borrowed money going forward. But that's basically the only spending priority that would have been the same under Clinton as it is under Trump. Otherwise, the priorities would have been different, but I think the amounts would have been pretty similar. In either case, we would go on spending way too much. In the last year of the Obama administration, the U.S. borrowed $1.3 trillion. Now, that's an immense amount of money for a government to borrow, not an entire country. That doesn't include mortgage, credit cards, student debt, et cetera, corporate debt. That's just the government. And this late in an expansion, it's really unusual for a government to borrow that much, because usually, by now, with most people back to work, et cetera, you got a lot of tax revenue coming in, and you're paying your bills reasonably well at the central government level. Well, this time around, we borrowed $1.3 trillion, which means we can't function without borrowing huge amounts of money, even in recoveries. So whoever's in charge, whoever would have been in charge, if, say, Clinton had won, she would have been borrowing a ton of money. Trump is going to borrow a ton of money and finance his priorities, because we have learned as a society a false lesson, which is that you can borrow as much as you want to. The government can run any kind of deficit it wants. It can borrow as much as it wants and totally get away with it. You don't get kicked out of office for running big deficits in the U.S. Or for building up huge amounts of debt, because you've got a printing press. You can create as much new money as you want to. You can peg interest rates wherever you want and give people the illusion that things are okay and that the government is well run. And these guys learned that lesson as if it's a permanent state of being. And it's not. It's just how things work while you're blowing up a credit bubble. All that new borrowed money makes things feel better. But eventually, when the bubble bursts, all that money you borrowed in the past makes things feel much, much worse. And we are heading that way very quickly, I think, now. And so eventually, debt is going to become a bad word again. But who knows when? It might be a few years from now rather than this year. I kind of think this year is going to be a tempestuous one. But you never know for sure.
You're listening to This Week in Money. Our guest is John Rubino, author of several books on the economy, including The Money Bubble. John, is anybody ever going to call these government loans?
Eventually, the debt has to be paid somehow. And we've got 3 or 4 options. Obviously we can just default on it and just say we're not going to pay, which some countries do. That's pretty rare, though, because usually countries take the other way out, which is try to inflate their currency away. In other words, we'll pay you back the dollars we owe you, but each dollar will be worth half of what it was when you lent it to us. And so that's what we're trying to do right now. We're trying to inflate away our currency, as is Europe and Japan and China and to a lesser extent Canada. You guys are generally better run than some of the other big powers, but you'll have to go the way of everybody else when the time comes. And one of the ways that we will see this government debt really start to bite is when and if interest rates go up. Already in the U.S., we've seen 10-year treasuries go from 1.4%, give or take, to 2.4%, give or take. That's a huge percentage increase in, interest rate that started out very low. And what that means is that all the new money that we roll over, at least in the 10% or 10-year maturity range, is going to cost us a lot more. And if you just have the U.S. go back to its historical average interest rate, in other words, what the government has pretty much had to pay for most of the last 70 years, which is about 6%, you would see us have to pay $1.2 trillion U.S. dollars a year just in interest costs at the federal government level, as about a third of the overall budget, which means we would see massive spending cuts or massive tax increases in order to pay for that. Either way, that really debilitates the private sector, right? If the government has to take a huge amount of money away from productive people who pay taxes and use it just to pay interest, then that's going to be really disturbing to the electorate and to the economy. Meanwhile, it dramatically increases income inequality because most government bonds are owned by rich people. So if they're going to see the interest that they earn on their bonds go up while the government is raising taxes or cutting spending on regular people, then the rich will get even richer relative to everybody else, and that's going to disturb the electorate. So however it works out, there's instability in the future. And one other option is to never let interest rates rise, which I think is what they'll try to do. Where, like Japan, they've pegged their 10-year bond rate at 10%, and the central bank will buy all the bonds out of the private sector that it needs to keep the rate at 10%, or at 0%. And the U.S. is probably going to try something like that at some point, where we just say, look, we can't have interest rates go up because of all the things I just mentioned. And so we'll say, from now on, 10-year treasuries are going to yield 1%. And if you've got some 10-year treasuries you want to sell to us, that's fine. We will buy them from you at a price that equates to a yield of 1% on those bonds. And so what that means is that the federal government will have to print or otherwise create all the dollars that are required in order to buy up all the bonds that are offered. And that is going to be really destabilizing too, because the supply of dollars will just go through the roof. And eventually you reach a tipping point where right now the world will basically soak up all the dollars we want to give them. But if we give them twice as many dollars, will they still want to soak them up and still want to treat them as something of stable value? Maybe not. And if we give them 5 times as many dollars as are out there already, will they still think dollars are valuable? Probably not. So somewhere out there is an amount of dollars that will tip the system over and cause people to lose faith in the value of the dollar, and then everything is over. Then we can't play these games anymore because we don't have anything we can give people to fool them into thinking everything's okay. And that's coming, Jim. It might be next year, might be the year after, but that is out there waiting to happen. And when it happens, you need to be prepared for it. And that's really the thrust of a lot of my writing on dollarclaps.com is, so what do you do? It's a given that we've got a crisis coming. So how do you prepare for it, and how do you protect yourself?
How do you protect yourself?
Well, you shift out of these dollars that the government's going to actively try to destroy at some point in the future and into real assets. In other words, take your dollars and you buy some stuff that governments can't just create in infinite quantities. There's a little bit of a debate going on among visitors to my site in some of the comments section about whether farmland is better than precious metals or vice versa. And I think that's an interesting discussion because there's a lot to be said for something like farmland or beachfront property or really well-chosen rental houses in college towns that are pretty stable, that kind of thing. Because you can't just, wave a magic wand and make a whole bunch more beachfront property or anything like that. Those things will tend to hold their value going forward in a currency crisis. But so will precious metals. Gold and silver have been through this before. Countries have destroyed their currencies, let's say several hundred times since the days of the Roman Empire. And in each and every case, the national currency was inflated away and it disappeared, and gold and silver remained valuable straight through it. In fact, they got more valuable as the currency was being destroyed. So I think if history is any kind of a guide, then you want to hold some other real assets, and possibly Bitcoin too, which is a new idea that might also hold its value over time. You want to hold maybe some cryptocurrency, maybe some well-chosen kinds of land or other real assets, and then some gold and silver. That kind of a portfolio will tend to do better than, for instance, a portfolio of cash and government bonds, which is what a lot of people have as the safe part of their nest egg, the thing they think won't lose anything. That's what will really cost them in the future. So you kind of have to flip your thinking on its head and come to the conclusion that cash is a high-risk asset, and you want to move it into something that's lower risk. So that's what you have to go through. And, a lot of people are, and it's getting easier and easier to think that way as time goes on, I think, for a lot of people.
What about the Warren Buffetts of the world? He's sitting on $75 billion in cash waiting for the next big thing to invest in.
Well, he is looking at buying profit-making enterprises. And he's, supernaturally good at choosing them, the kind that are going to keep on going through thick and thin. So you could make the case that he's also, he's raising cash, but he's not sitting on that cash investment. It's just he's waiting until things get cheap enough to be attractive for him to jump in. And what he'll buy will be, in a lot of cases, real stuff. A profit-making company that will continue to make profits as, a lot of the banking system blows up is a good thing to own. Now, for the average person, we don't have Warren Buffett's ability to look at Caterpillar versus Burlington Northern versus Canadian Railway or whatever, and decide among them and put our money into them with any kind of certainty. He can do that. The average person might do well by just piggybacking on what Buffett or one of the handful of other superstar investors out there who have been doing this for 30 or 40 years and are still successful at it are doing. But that leaves you open to a lot of volatility in the stock market. Warren Buffett can lose 50% on his stock portfolio and still be okay. Can you, if you're trying to retire? That's the big question. Especially if you're in your, middle years to later years, you want to be very careful about investing in things that are volatile. Because even high quality stocks can go down by 60 or 70% in a bear market. It's just the way psychology works. People get nervous and then they throw the baby out with the bathwater, and even good stocks plunge. So one of the things that the government in the U.S. is doing is, by cutting interest rates, encouraging even retirees to load up on equities, because that's the only place where you can make any money right now. And what they're doing then is building in a big crisis when the next garden variety bear market hits, in which a lot of people who shouldn't have been in stocks are in stocks and lose 60% of that part of their nest egg at a time when they were supposed to be drawing down on the nest egg. They were supposed to be generating 6% interest in a bank account. And instead, they're in this portfolio of growth stocks because the bank account pays 0.1%, and you can't live on that. So they see stocks going up by 8 or 10% a year and get into that thinking that it'll continue. Instead, they go down by 50 or 60%. And then, these guys are eating dog food or something like that, or moving back in with their kids. So there's a vast human tragedy being built into the system here. in the not-too-distant future.
John, thank you so much for chatting with us.
Sure thing, Jim.
My guest has been John Rubino, author of several books on the economy, including The Money Bubble, his website, dollarcollapse.com. Coming up, the Corbett Report's James Corbett, next on This Week in Money.
I'm Larry Reaugh, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, AMY, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Reaugh, at 778-574-4444.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. I'm Jim Goddard. We're speaking with James Corbett, publisher of the CorbettReport.com and editorial writer for the International Forecaster. He's speaking to us from Japan, where he's worked and lived since 2004. Welcome back to This Week in Money, James.
Well, thank you so much for having me back. Always a pleasure to be here.
One of the very first things President Trump did was sign a presidential order saying he would not go along with the TPP, Trans-Pacific Partnership. What's the reaction been in Japan and the rest of Asia?
Well, obviously this was telegraphed well in advance, and we've known that this was going to be the decision since the election took place. And Trump promised it would be one of the first things he did in office, and well, it looks like he's following through on that promise. So it is not surprising. It is still, of course, a monumental blow to the years of very secretive, very furtive coordination that these governments have been doing with large corporations to make this deal happen. But it is not all for naught necessarily, because, as I believe we've talked about before, back in November, as far back as November, China was already officially launching its own Pacific Free Trade deal, or at least floating the possibility of it. So the ultimate effect of this, interestingly enough, might be to actually bolster China's relative position in the Asia-Pacific markets and to make this more of an Chinese-led Asia-Pacific free trade partnership, with the U.S. getting out of that particular mix. So although the Trump administration has talked a very tough talk on China and talked about labeling them a currency manipulator and talked about tariffs and the potential launching of a trade war, the ultimate effect of this move is actually to strengthen China.
I know New Zealand, Australia were concerned about the U.S. position, but they said it's true. Asia and the other nations that are part of this might still have a real shot to make it go through and be successful with it.
Yes, that is true. In fact, the Australian government has come out. The Trade Minister, Steve Chiobo, said, "With the future of the TPP looking grim, my ministerial counterparts and I will work to conclude a study on the free trade area of the Asia-Pacific, which sets out agreed actions towards a future free trade zone." So Australia is still willing to go ahead and is looking at the China-led proposal for a TPP replacement. So even America's staunchest allies in the region are probably still going to go ahead with some sort of agreement, even if the United States is not a part of it, and even if it goes directly against ideas of U.S. hegemony in the region.
Has it a lot to do with projections that China will soon surpass the U.S. as the world's biggest economy?
Well, I think people can see which way things are trending, and of course we always have to be wary of trends because they can change, and things that seem like booms can be revealed to have been busts waiting to happen all along. But at least at this point, it certainly does seem that China is the natural, is coming to the point of taking a natural role as the lead player in the region, economically as well as militarily and otherwise. And I think people are reading the tea leaves, as it were, and seeing which way the wind is blowing and trying to get on board with the winning team.
Trump has complained about China manipulating its currency to favor its trade. Are they actually doing that?
Well, actually, I mean, it's interesting because certainly over the past year or two, the actual reality of it is the exact opposite. China has been spending its foreign reserves quite rapidly in order to try to stop the devaluation of the yuan, because they are facing a massive capital outflow problem, and they're trying to contain it. But that containment so far has resulted in foreign assets on the People's Bank of China balance sheet going down quite rapidly, and the yuan is still continuing to devaluate. So they are really throwing everything in the kitchen sink in trying to prevent the devaluation. So I think the reality is quite the opposite. Certainly in times past, one could make the charge that China was trying to manipulate its currency in its favor. But I think at this point, there really does seem to be a concerted attempt by China to really try to move the economy more towards a domestic-based economy, or at least more of that direction than on an export-dependent economy.
China charges tariffs on its imports. The U.S. currently apparently doesn't. What if the U.S. put up a trade barrier like that to Chinese imports?
Well, obviously, this is the big question, and China has already warned the U.S. that it would retaliate if tariffs were launched. So, I mean, the term trade war is being thrown around quite liberally these days, but perhaps for good reason. This certainly is the type of thing that could begin a trade war in earnest, and I think no matter what way that plays out, and whoever has the biggest guns to bear on that in that trade war, I don't think that would be a good thing for the global economy generally. Which, of course, even the ephemera of global growth over the last several years has really been built on the Chinese, especially the China-U.S. trading relationship, and to bring that to a halt would certainly put a giant damper on global trade generally.
Will the yuan continue to be pegged to the U.S. dollar?
Well, it would be an awfully large move if that were to change. So I wouldn't expect that to happen, barring, of course, some sort of cataclysmic trade war that really starts to escalate. But by that point, I think we would start to see all sorts of other ramifications of that would seriously derail or dehinge the global monetary order as it exists now. So I think that would be a type of apocalyptic event, really, or at least the signs of a coming apocalyptic event.
China a year ago predicted 6.7% growth in its economy. Just the other day, they announced that, yes, they had 6.7% growth. Can we believe these numbers, or do they always meet their goals?
They always meet their goal. Wouldn't you believe it? Wouldn't you? What a surprise. And this is, of course, not surprising because, as I believe we have discussed before, even the Chinese leadership does not believe their own numbers about their cooked books about the GDP growth and what have you. In fact, there was a leaked document several years ago from Li Keqiang, who was a high-ranking official in a Chinese province at the time, and he's gone on to an even higher rank in the Chinese Communist Party. The party committee secretary of Liao Ning at the time in 2007, and he was talking in this leaked document about how he does not believe the Chinese government's own GDP numbers. He says that other indicators like rail usage and things like that, actually, if you added them together, rail usage and energy usage, were a better indicator of GDP than the cooked books, which in fact it has been shown time and again, if you add up all the GDP growth that is reported by the individual provinces in China and then add them up, it comes to a different number than the national number. So you can see the cooking of the books even at that level. So it is not surprising at all that they magically came up with their exact target. And in fact, it's even better because for the first time in 2 years, China's economy has actually accelerated, according to the National Bureau of Statistics. That's a big asterisk right there, who are reporting a 9.9% quarter-on-quarter increase from Q4 last year in warehousing and delivery output. And Bloomberg and other analysts are putting this down to an increasing part of that economic growth coming from the service industry, waiters and delivery people, and even doctors and software engineers, rather than on smokestack industries and factory production. All of this, of course, has to be taken with that giant grain of salt. Not only the cooking of the books, but also the extent to which this is a paper dragon that has been constructed on the back of easy credit from the PBOC. Really, the two things they've done is provide massive liquidity and massive credit to fuel a credit bubble that has been the driver of Chinese growth for the last several years. And the best indication of that comes from recently released numbers from the Bank for International Settlements, BIS, on the credit to GDP number in the Chinese economy. They are saying that the Chinese accumulated debt right now is 28.8% credit to GDP. And to put that into perspective, the U.S. back at the time of the Lehman crisis in 2008 was 12.4%. And that caused a massive meltdown in the financial sector in the United States. How are we to believe that China, with over 200% of that figure, is going to be able to survive and thrive? Certainly they do have more of a productive and growing productive and manufacturing base to work from, but it does not, I think, portend well for a already very shaky situation. And it really is just a question of if, when, and how that credit bubble can be either grown out from underneath or popped. And that's really the question that people are looking at. And throw in things like tariffs and trade wars into that mix, and it's quite obvious that China is a paper tiger that could go up in flames very quickly.
We'll have more with James Corbett next on This Week in Money.
GEM International is a new diamond explorer in the richest diamond producing country in Africa, located next to the fourth largest producing diamond mine in the world. International Spotlight is on an 1109 carat diamond recently discovered in Africa by a fellow Canadian junior with a proven operator and finance team. GEM International trades on the TSX Venture Exchange, symbol GI. Visit us at gemdiamondmining.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. I'm Jim Goddard. We're speaking with James Corbett, publisher of the Corbett Report and editorial writer for the International Forecaster. He's speaking to us from Japan. James, the Chinese are famous for being big savers. Just how much do they tuck away?
That's a good question. I don't have figures for that in front of me, but certainly gold has become a more, it has, of course, cultural connotations in China, but it has become a very important place for people to save money, store wealth, and they have been buying gold in record numbers in recent years, to the point where China has been vying with India for the world's largest gold importer over the last several years, and has come out on top more years than not. So I think that's a good indication of the type of saving that's going on right now, and where that is ultimately going.
Are people in China worried, and in Japan as well, about factories there closing and being moved to the U.S. with Trump's protectionist policies?
I don't think that's necessarily the worry, so much as it is that there will be some knock-on effect in manufacturing here. But I think the point of Asia-Pacific trade deals without the U.S. and turning towards Europe, for example, to look for more export markets, is the idea that reading the writing on the wall, I think China and Japan and other nations in the Asia-Pacific understand that the U.S. might not be the reliable market for the exports of this region as it has been in the past. So I think they're looking for different ways to expand that. And I think obviously China has been working towards this for a number of years now with their one belt, one road policy to construct this incredible, gigantic, monstrous trillion-dollar infrastructure for a trading system, trading routes, trading relationships between all of the nations, connecting China and Europe, basically, in Central Asia, and creating this massive trading infrastructure. I think they've been planning for this for some time, so I think that's really where we're probably going to see more of the focus in the coming years, is away from the China-U.S. relationship as the anchor of the global economy towards expanding of trade between China and other economies, probably towards Europe.
Does China plan to have more direct investment in the U.S.? I heard, for example, they want to build the world's biggest windshield factory in the U.S.
Yes, I mean, it will be interesting to see to what extent, if the Trump administration is serious about cracking down on China and trying to contain them, to what extent there may be impediments imposed on the idea of foreign investment in the U.S. economy. I think interest from China in investing in various sectors of the U.S. economy will be there because, of course, there are opportunities. But the question really becomes, will they be allowed to invest so freely? And I think that's where we'll really see whether where the rubber meets the road, as it were, when it comes to Trump and the relationship to China.
How big a deal was it for Trump to talk with the president of Taiwan right after he was elected?
Well, this obviously upsets decades of diplomatic protocol. For people who don't know, this is about the so-called one China policy, which is that China thinks that there is one China and Taiwan is part of it, and the U.S. thinks that there is one China and Taiwan is part of it. The only question is, well, which is the real China and who runs it? Which is a pretty major asterisk there, but at any rate, we can all agree there's one China. So to directly take the phone call of the Taiwanese president and to communicate on that level with the president-elect at that time coming into office was obviously a very, very big finger in the eye to Beijing. And that obviously stirred the pot and did create a diplomatic ruckus at the time. And despite people's inclination to believe that this was just a clueless President Trump, or President-elect Trump at that time, doing something that he didn't understand the implications of, we are now told that it was months in the planning, in fact, that phone call. So it was not just something that happened on a whim. It was something that was deliberately done, obviously to stir the pot with China. And we can see, again, coming into his time in office, we've seen Trump do a number of things like this to take the opportunity to put that finger in the eye of Beijing. So I think clearly the theme, the tone for the relationship is being set right now. And it really does just remain to be seen what specific policy implementation occurs to really put that put that relationship on a different footing.
Does this make it kind of messy or difficult for Canada to maintain good trade relations with China and the rest of the Asia bloc and also maintain good relationships with the U.S.?
I think there definitely does become a political calculus in all of this, and obviously Canada will probably never try to rock that boat with the U.S. relationship very hard, because obviously remains the biggest trading partner and presumably will be in the foreseeable future. But if, for example, if the Trump government is serious about renegotiating NAFTA and things like this, it really could affect the U.S.-Canada trading relationship, and the calculus as to how much can we get away with in terms of trading with China as opposed to the United States might change, and there might be more of an incentive to focus on China rather than the United States. Again, I don't think that the relationship is going to be ever fundamentally severed, but certainly Canada is probably going to find itself in the position of having to choose more often than not than it has in the past.
These jokes about the close relationship between Putin and Trump, is there any truth to them?
Not that is actually identifiable or provable. There are some interesting connections that you can go back to, with regards to some property deals that, Trump has made with Russian mafia figures, essentially, in the past in Florida and other places. But in terms of direct relationship between Trump and Putin, as far as I know, there is no indication whatsoever of any actual evidence of such a relationship. And again, all of the documents that have been released so far from the U.S. intelligence community about allegations of Russian interference in the elections, etc., have been remarkably devoid of any actual detailed facts or evidence, as they even admit in their own documents, where they say that confidence in assertions does not mean that there is any evidence to support those assertions. Almost a direct quote from one of the documents that was released by the Office of the Director of National Intelligence about allegations about Russian hacking, quote unquote, of the election.
Merely a whiff of vodka, borscht, and pierogies, then.
I suppose so, yes.
James, anything else in Asia that we should be taking a look at right now?
Well, I think a big story of 2017, certainly for Japan, is going to be the question of their energy cocktail, which has, in the past few years, been remarkably devoid of nuclear energy. As I think we know, the percentage of nuclear energy contributing to the mix of energy production here in Japan in 2014, 2015 was 0%. And they are expecting something on the order of 11% of energy in Japan to be contributing to newly restarted nuclear reactors here in the country. Of course, the nuclear reactors having been shut down in the wake of the Fukushima event in 2011. So that has led to Japan becoming heavily dependent on liquefied natural gas. It is the world's largest importer of that, and in fact has, for most of the past year and a half, been the world's largest importer of coal. So it has definitely affected Japan's, its balance of trade, for example, going into negative territory for the first time in the recent years, and obviously also affected energy prices here and how that impacts on the manufacturing industry and ultimately prices of goods for exports. It has had a significant effect on the country. So the question really remains, how many of these reactor restarts that the government is planning and hoping to achieve this year will actually happen? And if they do, to what extent will that change the need for imports in the region? I think that will have a pretty large effect on Japanese industry.
James, thank you so much for speaking with us.
Thank you for having me.
My guest has been James Corbett, publisher of the CorbettReport.com. He was speaking to us from Japan. And that wraps up our show for this week. We'd like to thank our guests Ross Clark, John Rubino, and James Corbett. And thank you for listening. Now stand by for a company showcase update with American Manganese CEO and President Larry Reaugh. If you have any questions for the show, you can email us at info@howstreet.com. I'm Jim Goddard. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at talkdigitalnetwork.com. This Week in Money is a production of Howe Street Media Incorporated. Executive producer is Tom Allen. Welcome to Company Showcase, an advertising feature on HoweStreet.com.
We're speaking with American Manganese CEO and President Larry Reaugh. Larry, welcome back to Company Showcase. And by the way, we're chatting on January 27th, if people are keeping track.
Hi, Jim. I'm glad to be back talking to you again. I guess the conversation will be about the exciting Cambridge show that happened on Sunday, Monday, earlier in the week.
I understand attendance was twice or even more than twice what it was last year.
Well, I was down attending the show last year. This year we had a booth and were presenting, and I have to say that it was like night and day. I mean, there was a lot of optimism about where the markets were going, how the industry was moving ahead, how the mining and the gold and copper and were moving up, and just an undercurrent of optimism and excitement in the overall show. And there was a good cross section of professional people and investors that were interested in various aspects of the show. But I'd like to just kind of focus on how it went for us. Our booth was busy. We were there from the time the show opened till well after it closed on both days, and we were well attended. We had people from different parts of the world come by that were interested in our technology and looking at an investment opportunity in the company. And so we had a good cross-section of investors, a lot of them from locally, and but internationally as well. And, I felt that I didn't get a chance to go around and look at the rest of the show like I usually do, because we were that busy at the booth that we just had time to catch our breath, during the some lulls when the good speakers were up. And but I would say that we're definitely in a bull market. I would say that our recycling proposal has caught the attention of a lot of people in the marketplace, and we had a lot of happy shareholders that came by. Now, of course, on Monday and the rest of this week, we've seen the stock get ground down with low closes every day, but that's to be expected. This is a predator trading that's going on, and overall, I couldn't be more happy with the results from the show, Jim.
What do people find most striking about your product?
Well, they like the idea of us being able to recycle the lithium-ion batteries. We put a release out, given the value of some of those batteries, on a couple of days before the show, and they ran from about $1,400 to about $3,500 per battery, and that's not counting the $3 a pound tipping fee. So you can see that there's a lot of value locked up in the cathode material and the recycling opportunity. We got a pretty good handle on what it's going to cost us to do the hydrometallurgy, and the thing that we can only that we haven't done enough work on to basically tell anybody that what the cost is going to be for actually disassembling the battery and freeing up the cathode material. But there's a lot of money there to do that, and I did talk to a technology firm out of Europe that does that, and so there, and I discussed it with them, and there are opportunities for us to do that. So we'll be moving ahead on that front at some time. But it was they were also interested in our cobalt. Probably most of the shareholders don't realize that we have a very high-grade cobalt occurrence in one of our properties, which is up out of New Hazelton. And that property, was ran from a 1 to 4% cobalt, and had a nice kick in gold with it, too, from about up to about 6 ounces to the ton. So that is something that we will discuss. We've got interest in it, so we'll be discussing that at a later date.
Larry, one thing I'm curious about is we know about using various materials for car batteries and recycling them, but what about Tesla's plan to develop solar energy batteries for homes? Is that also an area that perhaps American Manganese could be interested in?
Well, that opens up other opportunities, that's for sure. And but is it going to be a lithium-ion base, or if it's another base like a nickel hydrate or something like that, that would not work with us. But there's all kinds of openings up: storage batteries, wall unit, power wall units, big solar batteries. All of those things could open up a whole vista. And to be honest with you, Jim, we're going to have our hands full just with electric vehicle batteries in the very early stages here.
Of course, the future's always brighter when you look longer and longer down the tunnel, but it's always nice to know, too, that a company is optimistic just in one area and can always expand later.
That's right. It leaves the playing field wide open for us, and and I just wanted our shareholders to know that we got a good reception at for those that didn't come by, that we got a good reception at the Cambridge show.
And for people just tuning in to us for the first time, Larry, maybe explain what American Manganese has discovered and its patents.
Okay, American Manganese has a existing patent that lends itself to the hydrometallurgy required in recycling lithium-ion batteries. And there was a concept which we've turned into a proof of concept. We've actually done that. We've filed for the additional patent that covers off all these chemistries in the lithium-ion batteries. And because it's going to be real problematic. I mean, you can't be a producer of batteries and electric vehicles, and which is all very great for the environment, environmentally friendly, But what are you going to do with your batteries at the end of the day? You can't just keep burning them up in smelters. That's wasteful, and it's not good for the environment.
Larry, how can people find out more about your product, and where does it trade?
We trade on the Venture Exchange under ticker symbol AMY, on the U.S. Pinks under AMYZF, and on the Frankfurt at 2 a.m. Those are the symbols. You can reach us at www.americanmanganeseinc.com. There's all kinds of information on the site. You can phone the office at 778-574-4444, or you can email me direct, and that's LREAUGH@AMYMN.com.
Happy Chinese New Year's, Larry.
Well, happy Chinese New Year's to you and all my shareholders.
Gong Hei, Pat Choi. We've been speaking with American Manganese CEO and President Larry Reaugh. I'm Jim Goddard.
Comments made on Company Showcase are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at HowStreet.com. Company Showcase is a production of How Street Media Incorporated.